Hi, I'm Tim Chubb, Chief Investment Officer here at Girard.
And I'm Tom Miller, Director of Investment Strategy here at Girard. So Tim, markets have been crazy. This quarter felt like a complete round trip. Take us back to late March and then where we are today.
Yeah, it's been really a remarkable start to the year. Coming into March, quarter end last time, we were faced with the conflict in the Strait of Hormuz, with the war with Iran. Oil prices were up over $100 a barrel. Starting to see some concerns around private credit, and the wall of worry was being climbed by the market. Now we've gotten some resolution on the conflict, and really a strong earnings season that's propelled the market quite a bit higher. And so for the first quarter, the S&P was down about 7%. I think we're up about 16% from those lows at the end of March, early April. And again, a lot of that was driven by earnings growth. This first quarter was really a blockbuster quarter. 28% profit growth on the bottom line, 11% on the top line. And a big piece of that was actually driven by a lot of the private companies that were going public and being revalued. Still 16-18% earnings growth on the bottom line, which is really a healthy market that's being driven from earnings growth as opposed to multiple expansion.
Yeah, and let's talk a minute more about that, because I think oftentimes it's forgotten, right? That earnings growth is what drives stock prices higher.
Exactly.
There's so many geopolitical risks out there, but what is it? It truly is earnings that will propel this market from here?
Yeah, and it's been earnings growth, for a select few companies that's really been at the, sort of the expense of CapEx from the hyperscalers. And so, for the last couple of years, we've seen these hyperscaler type companies, Microsoft, Amazon, the like, Google, really be the winners. The Mag 7 had driven market returns, pretty significantly over the last couple of years. But now that spending is eking its way into industrials, especially memory companies within the semiconductor sector, and even more broadly as the sort of AI, CapEx boom move, if you will, continues to expand. And so, ultimately it's, encouraging to see that earnings growth, because what would not be a healthy market is if investors were willing to just pay more for a dollar of earnings like we saw during the dot-com bubble.
Yeah, and to that end, with earnings growth finally starting to broaden out, you named a few of the sectors. Still somewhat concentrated though. Can you just talk a little bit about the quarter, because we've seen some pretty tremendous run-ups in certain sectors?
Yeah, absolutely. So, looking at technology and kind of decomposing that a bit further, semiconductors or chip companies are about 20% of the S&P 500 now, so a fifth. That's the largest it's ever been. And even looking at some of the semiconductor chip names, throughout the quarter, it really was just memory. And so about 80% of the gains that we have had off those March lows have been in those semiconductor names, especially the Microns of the world that have had severe bottlenecks, just given the amount of demand, for those memory chips and the AI build out.
And so what was the return for the chips this quarter?
About 90%.
Yeah, that's pretty amazing.
Yeah.